Luis, it's absolutely wonderful to meet you. We've got Luis Mayans here, who's the global head of private debt at CDPQ. One of the things that I think is very interesting about 2024 and private credit is what the space is for private credit when we also have some reopening of the liquid markets coming in 2024 and indeed already active. What's your view? The M&A environment's ticking up. BSL markets appear to be open for business. What do you feel about the upcoming year for private credit opportunities?
I think it is a positive year, Josie. I'd say it's a very good question. We're coming from a year where most of the activity was basically either refinancings or add-on capital to existing platforms rather than M&A and companies changing shareholders. So clearly that M&A activity was subdued in 2023. If I look at what we did out of the 16 deals that we did last year, only 2 or 3 were driven by M&A. 2 of them were actually P2Ps. When we're speaking to the sponsors and to the advisors, what we're hearing is there is obviously a backlog of deals that needed to transact and haven't. And we're also seeing that is a gradual adjustment of the bid-ask spread in terms of valuations. We haven't seen it materializing yet. In reality, it is probably too early. We're only a few weeks into 2024, but the expectation is that the M&A volumes will increase, and will increase across the board from the lower middle market to the mid market to the upper and to the large cap space. You've also spoken about how deals are being financed and the fact that the syndicated market, which has been subdued for a number of months, is now back in place. Is probably more functional, and it's offering a real alternative to sponsors when it comes to financings. So I think private credit has evolved from being a pure mid-market play sort of about 10, 15 years ago. And it's been taking more and more market share in the large cap space. One of the reasons is because the syndicated market has not been as active. I think the reason is because there's been an evolution as well in terms of what private credit can offer and what sponsors look for. To the extent that the company is highly acquisitive and requires follow-on capital and add-ons, I think private credit will still have a word to say to that. And I also think that when it comes to structured transactions, the level of pricing and the flexibility and the documentation are also linked to the underlying quality of the asset of the business that you're financing, as well as the size. And hence, there's been a certain convergence. So when it comes to choosing private credit versus the BSL, it's not as black and white as it used to be before. I think there's going to be a number of considerations. Probably last 18 months has been a period where private credit has been the prevalent option. If you ask me about 2024, I would say it's going to be more balanced. I also believe it'll be a market environment with higher volumes, and hence not necessarily taking away from the private market, but rather making a much bigger pie where there's space for both. Some deals being done in the syndicated market as some others being done in the private market.
Does it even necessarily need to be a syndicated versus private credit issue? Could you have deals where both have a role to play?
Totally, and we've seen in some periods where there was a syndicated deal in place, and the sponsor needed more capital, and the market was closed. We've seen some funds participating into those deals with a non-fungible tranche, sometimes even with a fungible tranche next to the syndicated deal. That was let's say a bit more ad hoc. I think going forward, it is not unlikely that for very large deals, we see hybrid transactions where you see tranches that are public and tranches that that are private. That has been the case historically when we were talking about senior and subordinated. We've seen an increased number of big transactions that were their response to interest rates having gone up and so much pressure on cash flows. But I think it is not unlikely that we're going to be seeing it in situations where you want to raise something that is pari passu and not 100% of a transaction is syndicated or private, but rather a mix of the two. Now, we've seen it in the US in some deals. It hasn't become mainstream, but I think it's one of the topics that we will see evolve during 2024.
Yeah, very interesting. I mean, you've talked about the benefits of private credit in many ways. There's also a huge role played by the high base rates that we see at the moment. They're not necessarily going to go away. Private credit can offer cash conversion opportunities. We've also seen a strong demand for leverage from sponsors. Now, these valuations indeed might be coming down and becoming a bit more realistic, but do you think that demand for leverage will nonetheless remain? And the same with the cash conversion question, providing that space for private credit to continue.
Yes, I think there has been overall, there has been an adjustment. So there's been some reduction in leverage, which is just basically an inevitable response to the fact that with the same leverage and the rates being 3 times, 4 times as high as they were in the past, the cash flows of the company would have been under pressure. Have we seen it as abruptly as we thought? Probably not. What we're seeing is that for deals of size and deals of very strong credit quality, lenders are still happy to provide a reasonable amount of leverage in terms of EBITDA multiple, provided that, one, the company is sizable enough, two, there's enough equity cushion, and equity cushion that can be seen as sustainable through the cycle, and also provided that you paid accordingly. There's also some mechanisms that can be used just to make sure that on the one hand, the company is protected. I'm talking about the peak toggles that sometimes come with these transactions. The company is protected because if they have a bad quarter, they can always pick partially some of the interest, and the lender gets a reward, which is an increase in the margin, given the fact that they're not receiving 100% of the interest in cash. So has the adjustment been total? Probably not. We've seen it, but we've seen it, and let's say it's more acute in transactions where the credit quality is not necessarily top decile, and not so much in those where there's still a huge appetite, because as we were speaking before, there's been a significant flight to quality when it comes to choosing the sectors in which private lenders are operating.
On that subject, that flight to quality has really defined 2023 to some very high quality deals in a very narrow range of sectors, healthcare and tech being two examples. Do you see some opportunity now in 2024 for deals outside of those sectors, maybe in lesser loved sectors, but in companies that are very much performing at the top of those areas?
I think the answer is yes, very selectively. I think there's a degree of optimism right now, but when we look at what's going on in the world and the geopolitical issues, the macro, you could still see a scenario where there's either a recession or a slowdown, and inflation hasn't gone away fully, and the interest rates are high. I would add to the sectors that you mentioned, financial services, particularly sectors like insurance brokers and others that are quite stable and resilient. I'm not sure whether we're going to see more activity. I can give you my perspective, which is we are focused and centering our portfolio into those sectors and happy to look at the adjacent periphery. And as you well said, for some sectors that are not necessarily as recurring in terms of the revenue and as strong in terms of the cash flow of those, we're happy to look at those leaders where we get comfort. Now, there are some sectors that are going to continue to be difficult. Anything that is related to customer discretion, anything that is overly cyclical, anything that has a strong element of inflation pegged to the cost structure. Those businesses are going to be complicated to finance as they've been in the past. But as M&A increases and the availability of capital has also increased on the debt side, I think it is not unlikely that the mix is going to be more diverse than it has been over the past couple of years.
Yeah. I have a pricing question as well. We've seen a few BSL pricings already so far this year where they're repricing their debt. Private credit has a huge volume of dry powder. Are we going to see some downward pressure on pricing as a result of that competition from BSL, as well as the phenomenal amount of dry powder in private credit, essentially weighing on the pricing that's able to be achieved?
It's difficult to say. I think there's already been some pressure. If we compare the deals that we did in terms of spreads, we compare the deals that we did beginning of 2023 with the deals that we've seen in the last quarter or that we're seeing right now. There is a delta. It's a function of demand and supply, and certainly the supply of capital has gotten back to pretty high levels. I think the key when you think about it is whether you as a private lender can justify that deploying your capital through private transactions provides you with an important premium versus what you could get as an investor if you were to invest it in the syndicated market. And I think the syndicated markets are more volatile. So you'd see tightening and widening of spreads happening more acutely and more quickly. Whereas on the private debt side, there's been rather stability and resilience. So the range of volatility, it is much lower. And although I would say that yes, there's been pressure and probably there continue to be pressure, I think that pressure is also linked to that. And private debt investors we consider ourselves rationally, economically rational. I think that premium continues to be there and continues to be the key element that allows us to say it's still worth and it's still appealing to invest capital into direct lending.
Sure. The one of the big stories of 2023 was returning capital to LPs, and without that M&A taking place, the pressure kind of grew. Towards the end of 2023, we saw a few dividend recaps hit the market. Do you think there's opportunity for those in 2024, or do you think M&A will take that role of returning money to the LPs?
I think there'll be a mix. I think there will be both. To the extent that the businesses have deleveraged and there's scope to kind of refinance and with the new refinancing also enabling a dividend recapitalization, we will continue to see some of those. The urgency to get them done is obviously less so when there's a more functioning M&A market. And also back to my previous comment, I think most sponsors are going to be privileging growth over realization to the extent that they can. We've seen some of them bringing businesses into continuation funds. And the main reason is because they believe that there's still value in holding on to those assets and continue supporting them as they grow, either organically, but mostly I would say through consolidation of the sectors. So I don't expect to have a wave of dividend recapitalizations. I do hope that M&A will take care of that. But obviously every year we see a number of them, and to the extent that they're reasonable and the equity cushion continues to be there, we're also happy to consider them and participate.
Well, let's incredibly frank and honest views there from you on a series of questions there. For anyone listening, Louis will be talking at the DealCatalyst event on the 29th about the rise of private credit in the past few years and an outlook for 2024. But I want to thank you very much for your time, and look forward to meeting you in person at the conference as well.
Likewise, thank you very much.